What if I told you that the strategy that I'm about to show you today made over $700 in profit? And all this happened when I was trading a small account. Today, I'm going to share with you a complete strategy on volatility 75 index that you can start using today and crash the market. But before I show you the strategy itself, you have to understand what volatility 75 is and how it performs. So in this complete guide, I'm going to share with you everything that you need to know and understand about volatility 75 index. And then I'm going to give you a step-by-step strategy that you can start using today, even if you have a small account. In fact, we tested this strategy 100 times and it gives us some amazing results. So let's jump into the video and get started. Okay, so what is volatility 75 index anyway? So this is just a synthetic index that is provided by Derif. You know, Derif provide these synthetic indices which are not real world markets, but this is a computer generated market. But this market imitates what happens in the real world markets, which means all the analysis that we can do except for news or fundamental analysis, it can work. So the reason why I love this market is that you can rely on technical analysis. Why? Because this is how this market is created. So we have a lot of these indices, like from volatility indices, we have boom and crash, we have jump index, we have a lot of them. But today we are going to focus solely on volatility 75 index. So why do I like volatility 75 index? There's a lot of reasons, but I'm going to just share a few. The first reason why I like volatility 75 index is that it gives you the biggest trends that allows you to grow a small account. As I said earlier, there is no better instrument for you to trade small accounts on than volatility 75 index. Why? It's because of the trend, which means if you catch one good trade, you might grow your account from like $10 to like $50. Let me show you what I'm talking about. If you look at this, you can see how big this trend is. This is a downtrend that moved for a long, very long period of time, which means if you had just placed your trade, your sell trade at any one point of this, and if you didn't have a very tight stop loss, then this simply means that you probably could have made money with this market. Reason number two why I love volatility 75 index is because it gives you one of the cleanest price action. I always say this: synthetic indices are very good to trade with price action. Why? Because they give you very clean price action. Let me show you an example right here. So if we look at this market, this is volatility 75 index, and this is a 5-minute time frame. You can see that there's a lot of levels of support and resistance, and this support and resistance have no fake outs. Like if you look in the real world, or if you look like on the gold chart, you're going to see that there's a lot of fake outs or a lot of false breakouts, and a lot of times where the market hit it's not really easy for you to draw support and resistance because the zones are just very random, because it is a real world market. And the other reason is that you can trade synthetic indices or volatility 75 index throughout the week, which means you can trade throughout even on the weekends. Let's say maybe you have a job or you are a busy person, maybe you only get time to trade only on the weekends. You can trade on the weekends if you are trading these synthetic indices. And these are just three of a lot of reasons why I love trading volatility 75 index. Now let me give you a step-by-step guide on how do you start trading volatility 75 index, and then I'll give you a strategy that you can start using that can make you money in the market trading volatility 75 index. And how do I know this? I will show you the entire process of me testing this strategy 100 times, and also some real trades that I placed in my account. Okay, so step number one is create a synthetic account with Derif, right? So when you open your account with the Derif broker, you choose if you want to trade the financial market or if you want to trade synthetic index. So you want to create a synthetic account. So how do you do that? You can go to Derif website and then you create your account, right? And if you don't know how to do that, I already have a video that explains that. I will link that video in the description of this video so that you can watch step by step how to create your Derif account and connect it to MetaTrader 5 so that you can start trading synthetic indices. And the other reason why you might want to choose Derif right now is because Derif now allows copy trading, which means if you want to copy trades from other people without you looking into the market, you can do this because they created this copy trading system which helps you to copy trade from other people. So if you want to join Deriv, you might want to use the link in the description to check out the copy trading system, and also check out our link. Maybe you can connect to our own account. Okay, step number 2 is create a trading plan for volatility 75 index. Yes, do not go into the market right now and start trading without a trading plan. A trading plan is very important for you if you want to make money in the market. So there's a famous quote which says, fail to plan and you plan to fail, which means if you don't plan your things, you are planning to fail, right? So if you fail to plan at the same time, there's no way that you are going to make money in the market. So let's talk about why do you need a trading plan when trading volatility 75 index or any other instrument on the market. So the first reason is that planning will help you to pick the best trades. Yes, because for you to plan, you want to have a strategy. So for you to have a strategy, you want to backtest the market. When you backtest the market, you see what are the best performing strategy and what are the best performing entries on your strategy. So it's going to be easier for you to place those trades and to know what are the best trades for you, right? Reason number 2 is if you have a plan, it keeps you away from overtrading. You see, there's a lot of reasons why people overtrade. Sometimes you overtrade because you want to revenge your losses. Sometimes you overtrade because maybe you just get into a winning streak and you start feeling like it's your chance to make as much money as possible. So you start feeling like you always have to be in the market. But if you have a complete plan, the plan is going to help you to make sure that you stay in your lane, right? Number 3, it will take the gamble out of you. You see, most people, when they are in the market, they are not trading, they are just gambling. For example, when you deposit something like $10 and you risk it on 1 or 2 trades, that is not trading, that is gambling. But if you have a small account, that means you have no choice but to do that. So, but if you have a reasonable amount of money, you have a trading plan and you stick to your plan, that means you are now, in this case, you are not just putting your money where you know that the odds are against you. You are just putting your money only when you know that you have the highest probability of making money. So there's a lot of reasons why you want to plan your trades. The other reason is that it keeps you focused, right? So if you have a plan, you can keep focused on your plan and on the long-term goals of why you are trading that account. Okay, so to create a trading plan, it's very, very easy. You just have to know a few things, right? So the first thing that you want to understand is you want to know what is the time frame that you are going to be trading volatility 75 index in, right? So volatility 75 index is very volatile and it moves a lot, as I said, right? So first you have to understand the time frame, right? So for me, I would say you have to trade this on 5-minute time frame or 15-minute time frame, right? If you go to higher time frames, that means you are going to have larger stop losses and you are going to be risking more. So if you are on a 5-minute time frame, since this have a clean price action anyway, you can still use the same price action that you use on higher time frames, and then you can have tighter stop losses or a little bit reasonable stop losses that you can have when you are placing your trades, right? So the first thing, you need to know your time frame. The second thing that you need is you need to know how much money are you going to be risking on each and every trade, right? So to do this, you are going to take your balance, right? The easiest way is take your balance. Let's say you have $100 in your account, right? And just ask yourself, how many chances do I want with this $100? If I was to lose everything of this $100, how many chances would I want to have, right? So let's say you are risk averse and you don't like taking risk, and maybe you want 20 chances, right? You want to be able to place 20 trades without losing everything, right? So that means you divide that 100 by 20 and you have $5, right? Which means each and every one of your trade, right? No matter how big the stop loss is, no matter how small the stop loss is, you are going to be risking only $5, right? That's your risk management, right? So once you understand that, right, just as simple as that, the next thing that you want is you want to know the strategy that you are going to use step by step, right? You need to know everything about the strategy. What are the conditions? The strategy should be very clear. You don't have to guess when you get into the market. You need to know exactly what are the conditions that you need to know to understand the trend. You need to know your entry triggers. You need to know exactly when you place your trade, so that when you open your charts, and if you don't see your setup, you don't place your trades. If you see a setup, you place your trades. You need to know your exit points, right? So your exit points, what I'm talking about is, as I said, let's say you are risking $5, right? You need to know, when am I going to get out of the market? So to do that, you're going to use what is called risk to reward ratio. In volatility 75 index, you only need to have like 1 to 3 risk to reward ratio. We'll talk more about that in a minute. But now let's talk about the strategy that you need to use for volatility 75 index. So I'm not saying use this exact strategy, no, but what I'm saying is you can use this strategy if you want to start right now, and if you don't have a strategy, you don't have anything. So I'm going to explain the strategy step by step. But first, let's talk about what makes a good strategy, right? So if you're trading volatility 75 index, what are the things that you need to know? What are the things that you need to see for you to say, okay, this is a good strategy, right? So rule number one, the strategy should be trend following. Never ever go against the long-term trend if you are trading volatility 75 index. Why? Because this instrument can trend for days in the same direction, right? I'm going to show you what I mean by this. You can see that this is volatility 75 index, and this is the 5-minute time frame, right? You can see how big this trend is, right? So this might not look as big as you might see, but from here to here, this is a very huge trend, especially for a 5-minute time frame. Because if you risk, so let's say if you place your trades right here with volatility 75, if you place your trade right here with the minimum lot size, which is 0.001, which is the nano lot, right? So if you place your trade right here with the minimum lot size and you exit right here, this move here could be worth more than $100. So what I mean basically is that one trade of volatility 75 index, one trade can give you up to $50 if you are using the minimum lot size. Now, if you are trading currencies, that's not going to happen. If you use minimum lot sizes, maybe the whole trend can go up, and you can expect maybe to make $15 to $20 at most. But for volatility 75, you could make $100 or $200 with one trend, right? So what that means is that don't try to oppose what this trend is doing, right? Because if you try to place reversal trades right here and the market is going in the wrong direction, chances are you might go for days just losing money on each and every trade, right? So the first thing you want to do is make sure that you are following the trend. That's rule number one. Rule number two is you should have at least 1 to 3 risk to reward ratio. So whenever you risk one, expect to make 3. Do not exit the market without making three times your risk, right? So let's say you are risking $5 on each and every trade. You are expecting to make $15 or more, right? So never take profits that are less than 3 times the risk. That's the rule for volatility 75 index. Why? Because it trends a lot. I'm going to show you another example, right? Let's say you were trading this market and you probably have seen that the market have gotten into this support, right? So here you have a reversal, the market coming back, right? Making this a strong support level, and then we have a break and retest, right? So we always talk about break and retest strategy on this channel, and break and retest strategy is one of the strategies that works on almost on a lot of instrument, which includes volatility 75 index, but it's not the strategy that I'm going to show you today. What I'm going to show you today uses simple indicators, and you have clear instructions, and it's very easy to use. I'm going to show you how to use it, right? So now you can see that again the trend is going to the downside. So let's say you were going to sell right here, right? So you were going to sell right here, and then you put maybe your stop loss right here. What you want to make sure is you have to have 3 times. So if this is $5, your profit should be at least $15. So you have to exit maybe at this point right here. You have to whatever happens, you just have to wait until the market goes down. In volatility 75 index, the market will do reverse and it will do go to the downside, right? And rule number 3, no trailing stops. If you are trading volatility 75 index, trailing stop losses can ruin your strategy. Why? Let me show you, right? So this market creates big impulsive moves and it creates very big reversals, right? So if you are trailing your stop losses, chances are when you trail your stop loss, the market might reverse and just hit your stop loss and continue going to the upside. Let's say you are looking at this trade, for example, right? And when you see this breakout here, a retest, and then you place your trade right here, you put your stop loss and your take profit is 3 times the risk, right? So the next thing that happens is the market moves to the upside, right? But if you think about it, let's say when the market got up to this point right here, if you had said, let me take my stop loss to break even, right? You just got a one big reversal that takes you out, and then the market goes all the way to the upside as you had already anticipated, but you would have lost this trade simply because you just trailed your stop loss, right? You can see here again another big reversal that came, and then the market kept pushing to the upside because this was an uptrend already. But then you can see how big these reversals are. So do not trail your stop losses if you are trading for the 75 index, right? So now let's talk about the strategy, right? And I would say this is the easiest strategy for beginners if you are trading for the 75 index. Okay, I'm going to explain the strategy step by step. Step number 1, step number 1 in the strategy is use the 200 EMA to identify the trend. As simple as that, right? So we are going to go into the market and we are going to insert the 200 period moving average, right? So you are going to put your settings to 200 and then exponential, right? So this is the 200 period exponential moving average, right? So that's step number 1, right? So the rule here is that if the market is trading above the 200 EMA, we are in an uptrend. And if the market is trading below the 200 EMA, we are in a downtrend, right? Just as simple as that, right? And step number 2 is we want to identify when a pullback is about to end. And let me explain what I mean by this. You see, when this market is trending, right? For example, here it's trending to the upside, right? We want to place our trades on the pullbacks, but following the trend, right? So for example, right, we want to try and place our trades at these points right here, right? So we want to try and place our trades at these points. These are the pullbacks because the market is going to the upside. So these are our pullbacks. If we are going to the downside, we are looking to place our trades at points like this, right? So this one is not yet a pullback, but if we get the market starting to push to the downside, so this is when we want to start placing our trades, right? So we only want to follow the trend, right? So first we want to make sure that if the market is going up, we are going up, we are buying. If the market is going down or is below 200 EMA, we are selling, but we only want to sell after a discount like this, which is a pullback, right? So that's exactly what we were looking to do, right? So how do we do this? So to do that, we are going to add an indicator, and this indicator is the stochastic oscillator, right? So the stochastic oscillator is an indicator. Most people just use it with a lot of lines and all those things, but for me, I found that the stochastic oscillator can actually help you to identify these pullbacks. You see, as an oscillator, right? If you think about all oscillator indicators, like the RSI, right? Most people use it maybe to identify overbought and oversold, right? Which is exactly what we want to do here. But we want to only identify the overbought or the oversold if it is going against our trend. So for example, what I mean by this is, okay, let me show you how to insert this and put some settings, right? But then I will explain what I mean by this in a minute, right? So when you put the stochastic, you are going to change your settings to this, right? You can pause here and take a screenshot of this so that you know these settings, right? Put the K period to 21, right? And then you disable the signal line, right? You disable the signal line. How do you disable the signal line? You do this simply by coming here where it says signal. You click this drop down and then you put white if your background color is white, or you can select none. If you are on your phone, you can just put your background color to white so that it matches your background, so that you don't see this signal line. You only want the main line, right? And then everything is the same, right? So once you do this, you add your oscillator like this, right? Now we want to talk about the entry triggers, right? So we are going to add another indicator for entry triggers, right? So we want to know the trend. You want to know when the pullback is about to end, and we want to know exactly when to enter the trade. To do this, we are going to add another indicator, and this indicator is called Williams fractals, or just fractals, right? So this indicator, what it does is, this indicator have no settings. So when you edit, you just when you edit, you can only change the color, but there's no settings for this indicator. But what it does is it shows you when the market is about to reverse for a very short period of time, right? So it just shows you an entry trigger, right? So the guy who created this indicator created it solely for entry triggers, right? So for this indicator, what it does is that if the market is reversing, right? So let's say the market is going up like this, and then it starts to reverse, right? When we have like momentum shifting right here, right, the fractal is going to be created, and this is when you want to be selling, right? So you want to be selling because it shows you it's so when this arrow is pointing up, that's when the market is reversing to the downside. So you can see right here, reversing to the upside, we have the arrow. The same thing here, the same thing here, the same thing here. Sometimes it fails, right? That's why we combine it with other indicators like the stochastic oscillator and this 200 period moving average, so that we can filter out fake entries, because this indicator creates a lot of entry triggers. So you can't just place trades on all these entry triggers. At the end of the day, there's nothing that you are doing, because you lose all your money through commission. So now let me explain the strategy, how it works, right? So let me show you how you enter and exit your trades. I'm going to show you a few examples, and then we're going to test this strategy for 100 times, and I will show you the results, how it performs, right? Okay, so this is the strategy explained in detail, right? So the first example, so this is the strategy, how it works step by step, right? So the step one is you want to find when the market is below the 200 EMA. This is for sell trades, right? So for sell trades, first find when the market is below the 200 EMA. So if volatility 75 index is below the 200 EMA, you are looking to sell, right? That's the step number one. So if the market is not below the 200 EMA, you're not looking for sales, right? Step number two is wait for the stochastic oscillator to move above level 80, right? So first I said the market is below, right? Is below the 200 EMA, and then you see, so you are not looking here. So when we say the market is below the 200 EMA, you are not looking here, right? You are looking where the market is at the moment, right? So I think this is something that causes confusion for a lot of people. So it has been moving below all this time, right? But look at where the market is. So right now the market is here, right? So when the market is here, just make sure that this point right here, this closing trade, the last candle, this last candle here is below the 200 EMA, right? That's what you want to know as the first place, right? So once that happens, right, step number three is wait for an up fractal to confirm your entry, right? So step number one, the market is below at this point right here where it is, right? Step number two, we said make sure this stochastic have gone above level 80, right? So this is where it went above level 80, right? So this at this example, we are a little bit late. This should be happening at this candle right here, but then you see it goes above level 80 here. Also, we see that the market is below the 200 EMA, and then step 3, wait for the up fractal to confirm entry. Now we have this up fractal here, right here, so which means this was a good point for you to place your trades, right? Now, but before you place your trades, you also want to know when to exit this trade, right? So the step number 4 is place your stop loss above the fractal, right? So you enter here. So this is a little bit late, so let's just say we ended right here. We got in this trade as it was playing out, right? So this is where your entry is. This is where your stop loss needs to be, right? So this is entry, this is your stop loss, right? And then take profit will be at least 3 times the risk, right? Now, when it comes to the risk, right, we said you need to understand we need to only risk $5 from this to this, or you need to risk, no, I'm not saying exactly $5, but you need to know exactly how much money you are risking per trade. So let's say you chose $5, for example, right? If you are risking $5 right here, you enter your trade, and then you can watch your trade manually, or you can just put your take profit where you know that it's 3 times, right? So maybe this is not 3 times, maybe right here, down here, it's 3 times the risk, right? So you have to make sure that you have 3 times your risk as your take profit. If you do this, you are going to find very, 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 very high probability trades with this strategy, right? So just to wrap up, step number 1, find when the market is below 200 EMA. Step number 2, wait for the stochastic to move above level 80. Make sure you are using the stochastic with the settings that I showed you. Step number 3, wait for an up fractal to confirm your entry. Step number 4, place your stop loss above your fractal. And then step number 5 is take profit should be 3 times the risk, right? So on the other side, we have buy trades, right? So let me show you another example, right? So that you really understand, right? So first here, what do you see? You see that the market is above the 200 EMA. So which means you are only looking for buy trades. If you look down here, you can see that our stochastic have gone below the level 20, right? When the stochastic have gone below the level 20, the next thing is what do we see? A down fractal, or a fractal that is pointing to the downside, which means we want to buy and go up, right? So here we are looking to buy at this point right here, right? So the next thing that we do is we place our buy trades. The stop loss should be below that fractal, right? So don't put it on the fractal, put it below the fractal, because sometimes what this market will do is that it's gonna reverse and retest this zone right here where the fractal is sometimes. So after the test that I'm going to show you in a few minutes, you're going to understand why I'm saying this, because I saw that most of the time the market will come and retest this zone where the fractal have been, right? So you always want to make sure that the stop loss is below this fractal, right? So the next thing that you see is that the market managed to push to the upside and managed to hit our take profit, right? And a good example of what I'm talking about the market retesting is here. You see, this is another condition. You can see the market is above the 200, the stochastic gone below the 20. We have a down fractal, so you could have ended our trade right here. So if you had put your stop loss on this candle, you could have gotten stopped out here when the market came to retest this fractal, right? And then you can see that the market did go to the upside, right? But then it came to retest this zone right here. So you want to always make sure that this is little distance between this zone and your stop loss. So just make sure you put a little gap between below the fractal, so that you give your chances, yourself high probability chances, right? Let me show you another example again, right? So let's start off by talking about conditions. Is the market above the 200 EMA? Yes. Did the stochastic go below the level 20? Yes, it did. So which means we are looking for buy trades. We are waiting for the fractal. Here you can see we got our first fractal here. We have another fractal here. So it's possibly a good place to place our buy trade. So what do? We go ahead and place our buy trade right here, stop loss below the fractal, and then the next thing that happens is that the market pushes to the upside. Also, we can see again the market came back to retest again this zone, which means we possibly can get a strategy which shows us. So I'm starting to think about it as I'm recording that maybe we should try to develop another strategy that wait for the market to retest this zone, and then maybe if this part of the stochastic is above this part of the stochastic, then it's a high probability trade because we have some kind of divergence. So I will think about it, and if you want me to research that strategy, test it 100 times and see how it performs, let me know in the comments. If I get 20 comments about that, I will create a video. So just comment, let's say you say try it, just comment try it, and I will try that strategy. Okay, so we can see that the market managed to move also to the upside in this case, right? So remember that these are only examples. I'm going to test these strategies in a minute, right? So now in this case, what do you see? First thing we see is the market is below the 200 EMA. So since the market is below the 200 EMA, what's the next thing you see? We are looking to sell, and what's the next thing we see? The stochastic have gone above level 80, right? So we are pushing to the downside. The stochastic is above level 80, and then we see an up fractal. Once we see an up fractal, we see we are looking to be placing our sell trades, right? So in this case, we sold. We put our stop loss above the fractal, and then the next thing that happens is the market moved to the downside, which is exactly what we are anticipating. Is it a 100% winning strategy? No, not exactly. In fact, if you want to see how much percentage win rate this strategy have, just keep watching it, because in a minute I'm going to show you the entire test that we did with this strategy. Okay, so here is another example, and I think this is going to be the final example before we jump into the test, right? So first we see the market pushing to the downside, right? So we see the market pushing to the downside. We also see that it's below the 200 EMA. That's why I'm saying it's pushing to the downside. We also see that the stochastic have moved above level to 80 here. And then when this happens, we also see an up fractal here. When you see the up fractal, what are we going to do? We are going to place our sell trade, put our stop loss above the fractal, and then what happens next? The market, we lost this trade, right? And this is not the only trade that we lost, which means we lost this trade right here, and we could have again lost on this trade right here. And why is that? We are losing these trades because there is no strategy that is going to win 100% of the time. So it doesn't work for me to just come here and show you a couple of examples, right? These are great because this helps you to understand this strategy, but for you to know exactly if this strategy can work for you in a long-term period, let me go ahead and test this strategy for 100 times, and I'm going to show you the results after I test it 100 times. Okay, so I went ahead and tested this strategy for 100 times. In the video that you see playing on the screen right here, which is fast forwarded, is me trading this strategy for 100 times to see how it could have performed if I was using this strategy since the start of the year. And also, I've been using this strategy on my own accounts, and the results have been amazing. But from the test that I did, let me show you what I realized. I realized that number one, when trades come after a price have been below the 200 period of P100 period for a long period of time, there's less chances to win. So the trades that comes earlier when the market have just crossed the below. So let's say these are sell trades. If the trades comes when the market have just crossed the EMA, there's high chances of winning than the trades that comes when the market have been moving, let's say below the 200 EMA for days and days, right? Then the second thing that I realized, that if trades come when the market is very close to the moving average or is touching the moving average, there is less chances of making progress because the market will likely just break the moving average and go to the upside. So you want to only place high probability trades if the market if there is gap between where the market is in the 200 period moving average. So in short, I'm saying you want to place your trades if the market is away from the 200, if there's a gap between where the market is in the 200 EMA, and if you find those type of setups, there's going to be high probability of you making money. Okay, so the results are finally in. Tested this strategy 100 times and the results are amazing. Look at this. You see, these are 100 trades that I placed, and these 100 trades took, I don't know if this is coincidence, but it took exactly a month and 2 days. So we just say 1 month. If you are trading every day, it was going to take you exactly a month to get these results. So what I did was, I was using this strategy backtesting tool that I created, right? So this strategy backtesting tool helped me to record everything about the backtest that I'm doing, right? So if I'm testing my strategy, I'm using this backtesting tool. So what this does is I can record, was the trade a buy, and what is my stop loss? Did I hit 1 to 3 risk to reward ratio? So if I click yes here, it calculates the results that I should have gained. If I click no, it calculates the loss, right? And just to make things interesting, I also tested with 1 to 4 risk to reward ratio, right? So I have never seen this before. This strategy managed to give me like 12 or 13 wins in a row using 1 to 4 risk to reward ratio. I've never seen that before, but this is amazing. Okay, so you can see after that, I have gotten also a loss of losing streaks, right? A lot of losing streaks, but then the strategy was recovering, right? So after 100 trades, this is what I got from this strategy that I just shared with you, right? So we managed to get so these are not 100 trades. In fact, we got 45 winning trades, we got 58 losing trades, right? Which means after all these trades, the win rate was 43.69%, which means this strategy is not a 100% win rate strategy, as I said, right? And also the gain on account was $1,320, right? So if you were risking $10 per trade for each and every trade for 100 trades, this you could have made a total gain of 1,320, and then a total loss, a total loss of 580. So most people don't like losing, but now you see losing is part of trading. You can't make money without losing, right? So 1,300 in profit, 580 in loss, and a total of $740 in profit, right? Risking $10 per trade. But are you going to do it? Let me show you why you are not going to do it. But before, you can see also when I did 1 to 4 risk to reward ratio, you can see win rate 36%, total loss 65 losses and 38 wins, also 870. So 1 to 4 risk to reward ratio made more money than 1 to 3 risk to reward ratio, right? Which means, I guess, the bigger you go with the risk to reward ratio, the less your win rate be, but the more money you can make, but the more your emotions are going to be tested. I'm going to show you why these results are not typical. If you trade this 100 times, you're not going to make this. Even if I do trade this 100 times, I'm not going to, if I had traded it 100 times using this strategy, maybe I would never had made this amount of money. Why? There's a lot of reasons. Why? Because when time like this come, when you get 11 losses in a row, maybe you have a $200 account, and in this case you are risking $10 and made 11 losses in a row, you lose $110. Are you going to continue using this strategy? Are you going to continue using this strategy? Most people will never do that. Most people will just change the strategy, and I think almost everyone will do that. That is why almost everyone loses, right? And also the other thing is that you can see, are you going to keep doing that? But what the funny thing is, after that you got 2 winning trades, for $40 each, and you covered almost 3/4 of the losses that you incurred in this period. But most people will never know that, and they will never attempt to keep trading if they keep losing like this, right? So that's why I think most people would never make the same amount of money even if we traded this strategy together, right? Also the other thing is that these results are not going to be typical. Why? Because you're not going to place each and every one of the trades. Sometimes you are going to be late on those trades, but in backtests you don't account for that, right? And also sometimes these trades can play out in the middle of the night when you are sleeping, so we don't also account on that. So the results of the backtest are not going to reflect what you are going to get in the actual strategy, but this is just to show, or this is just for you to have confidence that this strategy can work, so that if you start using this strategy, you know exactly when to place your trades, you know the results to expect, you know that when the losses come, the winners are going to also come. Okay, so if you want to see a complete video of me testing this strategy, I'm going to explain a lot of things about this strategy because I did create a whole video. I will link it up here, so make sure you click this video so you can start watching it and see me explaining the strategy in detail, how to use this journal and how the strategy works. Also, so what's the solution to this? I think the best solution is to build a trading robot based on this strategy. But should I create a trading robot based on this strategy? That is exactly what I'm thinking to do. And if you guys want me to record that and share it with you, make sure you comment below just to say trading robot, and I will know, because I will read all the comments of this video, and what you request is what I will try to do. For now, make sure you watch this video if you want to see me testing this strategy step by step, and you want to see more results from more pairs. Make sure you watch this video on the screen, and I'll see you in the next one.